The Magnificent Seven tech stocks alone make up roughly a third of the S&P 500, but are investors getting more nervous about that concentration? This is Sectors Up Close, and we're talking big tech. The Magnificent Seven tech names, Alphabet, Amazon, Apple, Microsoft, Meta, Tesla and Nvidia, have dominated market gains in recent years, but the enormous costs of building out AI are putting investors on edge. Last week, Microsoft had one of its worst days in years after its results showed $280 billion could be at risk as its prized asset, OpenAI, loses momentum. So should investors be picking the winners and losers or getting out of big tech altogether? Brian Krawez is president and lead portfolio manager at Scharf Investments. Brian, big tech stocks have been treated as a safe bet by investors in recent years, but are they?
Yeah, thanks for having me. They are big dominant companies, and as you said, Mag 7 alone is a third of S&P 500. In fact, if you look at tech and what we call tech-like stocks, they're now 49% of the S&P. So we think this concentration is being mistaken for safety. And in 25, really markets were driven by high beta and AI names. We actually think there's really great opportunities outside of the Mag 7. So we do think investors should be a little bit careful of this trade that's been going on now since OpenAI was announced in November of 22.
The scale of capital spending on AI really demands significant additional profits from the Magnificent Seven to show that spending is worth it. Can they make them?
That's a definite in question. The Mag 7, it's been estimated by McKinsey that by 2030, they're going to have a cumulative $7 trillion with a T, trillion dollars of spending. If they were just to make, say, 15%, which is well above their standard RICs of 25 to 30, they would need to have just a massive over $1 trillion return from these investments, and clearly nobody knows if that's going to happen or not, which is one of the reasons you're seeing some heartburn in the AI trade more recently.
Let's talk about picking and choosing individual names here. The big sell-off last week was Microsoft. Does its exposure to loss-making OpenAI mean investors are right to sell it?
Yeah, as we said, we think investors should be looking outside of tech. So we've got a lot of names outside of tech, but Microsoft is actually one of the few Mag 7s we think is still worth it. If you look at the quarter, it was actually a pretty good quarter. Revenues were up 15%. Azure revenues were up 38%. EPS was up 21%. Investors were disappointed because they were hoping Azure would be, the whisper number was 40%. But their cloud is now, $200 billion annual run rate business. It's growing tremendously fast, as I said, 38%. When you look at their RPO, which is the big thing that drove the stock down, while 45% is related to OpenAI, the other 55% is related to other customers and is well diversified, growing at 28%. So at the end of the day, now the valuation of Microsoft has come down. It's actually trading just a little around the S&P 500 multiple.
Which of the Mag 7 would you stay away from then? Where shouldn't investors have faith in the returns?
I mean, listen, any of the Mag 7 could certainly work out. I mean, the first one to point to is Tesla, which I like to say is all hat and no cattle. I mean, they had the first revenue decline in their history in 2025. They had earnings of roughly $1.08, and yet the stock is $430 or so. So you basically got a multiple that's not really tied at all to fundamentals. It's more based on risky moonshot optionality. Investors are hoping for robots and this and that and robo-taxis and all kinds of things that we don't see yet.
Briefly, Brian, should investors now be focusing more on picking and choosing the right exposure to tech or reducing their exposure to tech altogether?
I would say both. I think that since ChatGPT was announced, as long as you own the winners, i.e. the ones that were seen as quality companies, it really didn't matter. They all kind of went up. Now you've seen more and more companies being challenged on a stock price, and more investors are getting worried. You're still seeing tremendous gains in certain sectors, particularly up until a couple of days ago. We had memory stocks going up like crazy, for example. But we think investors have to be much more discerning. And is the other part of your question, we think investors should just have less tech in general. If you look at last year, high quality, what we look at is those companies with the highest earnings predictability. They were actually only up 2%. Similarly, low volatility stocks were up, less than the 5%. And so really it was a sort of high beta AI rally. What that's done though, is we're actually really excited because for the first time in, over a decade, we're seeing some really high quality companies that are actually trading at well below market multiples. And so for investors willing to pivot away from tech, there's actually better opportunities than we've seen in some time.
That was Brian Krawez of Scharf Investments. Don't forget, you can watch more videos on Reuters.com.